So now that we know how to figure out what they owe in taxes, now what we want to do is we want to figure out how we can make that less, right? Because we don't want to have to like owe that at the end of the year when we do our taxes. So here's how we then will take out our tax credits and withholdings. So you may qualify for various tax credits. So tax credits are subtracted from your owed taxes directly, which is great. So examples of this are a child tax credit. There's child and dependent care credit. So if you're paying for your child to be in childcare, or if you have someone that's a dependent, maybe like an elderly parent that you're taking care of, you can use that as credits. There's lots of energy credits out there as well. So to cover taxes also, so on top of tax credits, most employers are going to withhold money from your paycheck. So if you look at your paycheck, you can usually see where federal taxes were taken out. And they send that directly to the federal government, which basically kind of acts like a tax savings plan. So withholds are deducted from the amount of taxes calculated after credits are applied. So again, what you're kind of doing, what your employer does, for the most employers do, is they automatically have part of your paycheck go directly to paying off your federal taxes. So that way, instead of all of a sudden getting hit, like in that last example with Tina and Amir, with them getting hit with a $20,000 owed taxes at the end of the year, instead of that, there's an amount that's coming out of every paycheck, so that way they're not having to pay so much when they file their taxes. So let's look at an example. John's taxes are $4,342.50. He can claim a tax credit of $2,300, and he had $4,135 withheld from his paychecks. Determine if John will owe money or if he'll get a refund. So the first step to reduce John's taxes by the full amount is by subtracting that tax credit. So he owed $4,342.50. So what we can do is we will subtract any credit. So any credits that he got a $2,300 credit. So this gives us a total of $3,042.50 that he actually owes. So again, tax credits are great because they just get subtracted right off the bat. So he ends up, even though for taxes, when we calculated those, we found he owed $4,342.50. Because he had a tax credit, he got to subtract that away. So he actually owes $3,042.50. So he owes that much money. Now, he's already paid, he's withheld $4,135 from his paycheck. So again, when you look at your paychecks, there's an amount that gets withheld every month. So he's already paid that amount out of his paycheck. So when I subtract what he's already paid in taxes to what he needs to pay, we end up getting a negative balance of $1,092.50. So this means that John's going to get a refund of $1,092.50. Again, the way this is calculated is you figure out what you owe in taxes, which we just did in some previous examples, subtract any tax credits. That's actually going to end up being the total amount that you do owe. Most employers take out federal income tax, so most of the time you've already withheld and paid some throughout the year. So subtract what you've paid throughout the year, and whatever's left over is what you owe or what you overpaid, so you end up getting a refund. All right, let's look at another example. Phyllis and Gladys owe $16,519 in taxes. Their employers withheld $8,980 and they received a $7,500 credit for purchase of an electric car. So right now there's a lot of tax credits out there for electric vehicles. Will they receive a refund or will they need to make a payment? So let's figure it out. So we know right now they owe $16,519 in taxes. We can subtract any credits that they get. So they got a credit of $7,500. So that means in total they end up owing $9,019 for the year. Now, let's see what they've already paid. So we're going to take that amount and subtract what they've already paid in taxes. So they've already paid in taxes throughout the year $8,980. So that means what's left for them to pay is $39. So this means when they file their taxes, they're going to have to pay, they're going to owe $39 in taxes. That's what they have left to pay on their taxes. So I'm going to write $39 left to pay on their taxes. So they'll have to make a payment of $39. Okay, so let's kind of put this all together. Jennifer and Louis are married and file their taxes jointly. Jennifer has $68,000 in wages. Louis has $56,000 in wages, and they earn $1,320 in interest from their savings account. Last year, they were able to contribute $5,300 to their tax-deferred 401k. Their itemized deductions were $18,750. So first, let's figure out what is their adjusted gross income. So again, what is their gross income? So the gross income, if you look at that table that we learned at the beginning of this section, so that's adding up all their earnings. So we had $68,000 in wages for Jennifer, plus $56,000 in wages for Louise, plus the amount that they earn in savings of $1,320. So this means that their gross income is $125,320. Next, what's their adjusted gross income? So for adjusted gross income, you take what they got for their gross income, so $125,320, and we're going to subtract any tax-deferred accounts that they put money into. So they contributed $5,300 to a tax-deferred 401k, so retirement plan. So their adjusted gross income is $120,020. Should they take the standard deduction, or should they itemize their deductions, and why? So we know for itemizing their deductions, they'll get $18,750. If they were doing the standard deduction, here is the standard deduction table again. So they are married and filing jointly. So the standard deduction is $25,900. So which deduction should they take? The itemized of $18,750 or the standard of $25,900? Well, they should take the standard deduction because that's more. You want to deduct as much as you can off. So they should take the standard deduction of $25,900 because it's more money that they're going to be subtracting off of their taxes. So to continue going on with this problem, determine their taxable income. So remember that taxable income is you take the adjusted gross income and then you're subtracting any deductions. So in this case, we decided to take the standard deduction. So that means we found earlier the adjusted gross income was $120,020. They're going to take the standard deduction because that was more, so $25,900, and they're left with $94,120 for taxable income. So now, if they receive $3,500 in tax credits and had $5,200 withheld, will they owe money or will they receive an income? So let's figure out first what they're going to owe in taxes. So let's first find the taxes amount. So to find that taxes amount, we need to go to that tax bracket. So if we pull up that married filing jointly tax bracket for 2022, we find they get into that 22% tax rate. So that means what they're going to owe on taxes is $9,615 plus 22% of the amount over $83,500. So plus 22%, which is 0.22 of multiplication, the amount over $83,500, which is found by taking what they made, so $94,120 for taxable income, and subtract that $83,550. So that's what they'll have left over the $83,550. When I do that, I end up getting a value of $11,940.40. So they owe $11,940.40. So now let's figure out, okay, let's take off our credits and the amount of money that they've already paid. So if we figure out the total taxes owed at the end, so we're going to take what the amount that they owe in taxes, $11,940.40. We're going to subtract any tax credits, so $3,500. And then we're also going to subtract what they've already paid in taxes, which is $5,200 because they had that much withheld from their paychecks. So in total, at the end of the year when they file their taxes, they're going to owe $3,240.40. So they are going to have to make a payment of $3,240.40, but that's a lot less than $11,940.